Welcome to the Leadership Lyceum, a CEO's virtual mentor. Now, here's your host, Tom Lindquist.
Thanks for joining us in the Leadership Lyceum, where we bring you direct access to CEOs, directors of boards, executives, and other leaders. The Leadership Lyceum is proud to welcome Transparent Career as the sponsor of this special episode of a CEO's virtual mentor on shareholder activism. Transparent Career, connecting the best MBA talent and employers. As you know, we operate two companies under Leadership Lyceum's brand, Lyceum Leadership Consulting, which provides executive and board of directors search, board effectiveness review, and an array of services for successor development and board readiness, and Lyceum Leadership Productions, which brings you this podcast. Our past two episodes have included segments on shareholder activism provided by our guest Chris Young from Credit Suisse. Episode 11 included a historical look at the development and mainstreaming of shareholder activism as an asset class and the institutionalization of corporate governance through firms like ISS and Glass Lewis. Episode 12 looked at the vulnerability framework and what brings companies to the attention of the activists. We mentioned in a prior episode that a Wall Street Journal article had concluded that shareholder activism, which has been a perennial nuisance for chief executives, was now becoming an existential threat. So what is it like to be in the crosshairs of the activists, and what should you do about it? This episode 13 is our big shareholder activism episode. We take you step by step down the escalation path through 8 phases, including the letter and through the proxy contest. Chris Young from Credit Suisse will provide the steps and the pathway. Governance expert Tanuja Dehne will provide some governance and management considerations along the way. Paul Toback will discuss his firsthand experience of being CEO at Bally Total Fitness and in the crosshairs at points along the path. Highly experienced independent director Marjorie Bowen will provide context as an activist board nominee in the setting of activism and also provide governance and management advice for these situations. We'll be right back with our special episode on shareholder activism sponsored by Transparent Career. Transparent Career is your solution for finding and hiring the best MBA talent. Leading Fortune 500 companies use Transparent Career to hire top MBAs across their organizations. Transparent Career's comprehensive search tools simplify the process of finding the ideal candidate for your role. Plus, you can easily set up interviews directly through the platform. Hire the best business talent every time with Transparent Career. Learn more now at transparentcareer.com. And now our special episode on shareholder activism brought to you by Transparent Career. Let's join Chris Young, head of the Contested Situations Group at Credit Suisse. Chris, if we revisit what you said by laying this out in the form of the steps the activist takes, there's a sequence and there are several options at each node where they could potentially exit entirely and let the pressure off. How does that sequence work, and what is at these decision points or nodes?
Decision point, decision tree, absolutely. Obviously, I'm not an activist investor. I don't know how they come up with their ideas. I mean, we have a sense of it, right, just speaking with them. And I call it an escalation path. Typically what you see, first of all, an activist will make investments and not go activist, right? They have positions in stock where they are passive, just like other investors.
Chapter 1. The Position. Here's independent board member Marjorie Bowen.
If you think about corporate activism, really it's a distrust of management and the board. At the end of the day, it's a lack of confidence and it's a lack of trust. And because of the disclosure requirements and communication constraints that are associated with that, a board or a management team cannot sit down and have a candid conversation with an activist unless that activist is willing to say, I'm not going to trade this stock.
You mentioned the distrust of management. They're
Right.
giving a lot of information, but it's not very deep information.
Right.
And not very actionable information that people can make judgments about. As you say, there's a distrust in management on one hand, but it seems like the only thing that a shareholder can effectuate to find out more deep information that they can actually make judgments on is going down this escalation path to try to do it. Whether you trust management or not, maybe you find at the end of the day is trustworthy, but there was no avenue by which they could share this sort of information. And you had to go through this costly process to
That's
find
right.
it out.
That's exactly right. But keep in mind, activists generally are not getting involved with companies that are performing at or above the median in the industry. There's some level of financial discomfort going on for an activist to get involved, right? There's some underperformance. The biggest prophylactic against having an activist involved is do well vis-a-vis your peers, and chances are pretty good that even if an activist does get involved, you can say, well, explain to us what you'd like us to do better, and we are all ears, and the results will speak for themselves. Unfortunately, and I really, when I listened to Chris's segments, I completely agreed, strong performing companies don't have these problems. So it is a dilemma of weaker companies. Those boards tend to be quite defensive just by human nature. And there's a mistrust because these boards have failed in the view of the shareholders, or the management team has failed in the view of the shareholders to perform just at some average level. Then there's a lot of fumbling around in terms of, well, how well do they handle the activists' inbounds, right? And Chris probably is more knowledgeable about this than I am, but whenever I am asked by an activist to get involved, I want the background, right? I want to understand, well, have you tried to talk to management? Because, by the way, I don't really want to pick a team that hasn't tried to be productive.
Let's join governance expert Tanuja Dehne. And it's with great pleasure that we announce that Tanuja Dehne has joined our team at Lyceum Leadership Consulting. She brings her expertise to our board effectiveness and executive team effectiveness service offerings.
Shareholder activism may not always be such a bad thing that directors and management teams are fearful of. Oftentimes, there's a reason why an activist is getting interested. And it's a reason that hopefully a board and executive management team has some understanding of, especially if they have a solid investor relations team. Like, what is the street interested in? What are they caring about? Activism is not always a bad thing. I've actually had experience on a few occasions where we were preparing when we can start to see things are happening. I mean, there's typical cycles where you can start to see if positions are growing in the stock, and it's usually around the filings of the 13 Ds and G filings. It's at the mid-quarter. As part of an investor relations team, you're watching for that. And then you get your reports in from whoever your vendor is, your stock surveillance company, and you can start to see what's happening. But it's more than that. It's your investor relations. They'll start getting incoming calls, and there's a theme to the questions that are being asked.
Here's Paul Toback, former CEO of Bally Total Fitness.
I'm delighted to be joined here today at a very busy University Club in Chicago on May 3rd, 2017 by Paul Toback, founder and CEO of Sproing Fitness and Sproing Sport, which was built around a revolutionary soft surface interval trainer that he co-developed and invented with another fitness industry veteran, Steve Lentz. Thanks for joining me here today, Paul.
Thanks for letting me join you.
By way of background, Paul's a graduate of Stanford University with a BA in political science. He then went on to law school at the University of Chicago, earning a JD in 1987. Paul joined law firm Katten, Much & Rosenman, and then moved into city service as chief administrative officer and assistant to the mayor of Chicago. This was Richard M. Daley from 89 to 92. Then into the White House as executive assistant to the chief of staff to President Bill Clinton from 93 to the end of 94. And after service at the White House, he led an engineering service provider serving municipalities as chief operating officer before joining Bally Total Fitness as senior vice president of corporate development in September of 1997. By June of 2001, he was promoted to executive vice president and chief operating officer, and then in December 2002 at Bally was appointed to president and CEO, and 1 year later added responsibility as chairman of the board. He left Bally in the midst of drama in August of 2006. And although this is ancient history, and we're looking back at a time period between 11 and 20 years, when you were appointed CEO of Bally in 2002 timeframe, beginning of 2003, it was generating just around $1 billion in revenues at the time, just a little under. It was the largest publicly traded health club operator in the U.S. It had 360 outlets in the U.S. and 50 internationally, and had 3.6 million members. What was the state of things when you took over as CEO?
So the real interesting thing about Bally at that time was I think there were two states. You hear a lot of talk now from the White House, which kind of ties everything together, about a hidden state that they believe exists in the federal government. I think there was a state that we perceived, and then there was an actual state, right? So When I took over as CEO of Bally, the company had been growing. It had been acquiring a lot of other companies, but the operations were in need of some help. Revenues were stagnant. The strategy was a little muddied. We had been acquiring brands that didn't necessarily fit with the core brand of what we did. And so there was a need for an operational enhancement for the company to grow faster and further. And the idea was to really make the operations tighter and to consolidate under one brand and do things like that. Unbeknownst to me, there was also a complete deterioration in the company finances, masked by our accounting systems, and what we soon discovered was an accounting fraud. And so those things were really undiscernible when I became CEO and quickly did become apparent. And so that kind of created multiple paths in terms of our challenges. We had to continue to work on growing revenues, continue to work on streamlining operations and making them effective. And at the same time, we had to deal with shareholders and bondholders and, of course, the SEC as we kind of uncovered and then dealt with an accounting fraud and scandal. Mm-hmm. So we quickly discovered the hidden state and then had to deal with it.
How were you segmenting the priorities out on what you were going to face? And I'm sure the accounting issues probably overshadowed everything. How did you look at the different pieces?
Well, the lines crossed, but they didn't cross immediately. In other words, there became a time where the accounting did overwhelm everything we were doing. But at the beginning, it wasn't really like that. At the beginning, it was a kind of laser-like focus on operations and trying to take the company to the next level. So, when I first joined Bally, I used to say that Bally was like $1 billion startup company, in that there was a lot of opportunity on the table that hadn't really been leveraged. Mm-hmm. So Bally at the time had, like you say, 3-4 million members, multiple hundreds of locations around the country. We operated in 29 states and Canada. We had 120 million visits a year. We were the largest and only national fitness chain. The chain had been founded in the early 70s and had been around. Most people, when they saw any fitness ad, research showed, thought it was a Bally ad. Like, that's how ubiquitous the Bally brand had become in fitness. At the same time, there were operational challenges. The brand had grown by piecing different companies together, so the cultural assimilation definitely needed some work. And again, the platform really was used just to sell health club membership. And so I originally came to that company to help leverage the customer base to sell other things. We would go out our front door and see nail salons and juice bars and GNC selling vitamins, all people who were feeding off the membership base we were attracting, and we weren't getting any of that revenue. We used to say people would come to Bally and they'd all be in gym shoes and t-shirts and buy locks and flip-flops and all this other stuff, and we didn't sell them any of that. And so my first job at Bally was really to leverage that membership base, and we opened what wound up being close to 300 retail stores inside our clubs. We started a personal training business, combined that with leveraging the brand into a licensing and sponsorship series of opportunities. So we partnered with Unilever, and we promoted some of their products, and we partnered with Dove, and we partnered with Kellogg's and Kraft. We did all kinds of cool partnerships where we gave out our own guest passes and we promoted their products. We partnered with Michael Jordan in the release of his new book. And so there were lots of really cool ways that we leveraged the brand, none of which had been done before. Personal training had been around for a long time, but we kind of developed it into a captive business owned by us, trainers employed by us with real processes and systems. And that entire ancillary set of revenues for us became a big part of our total revenue. I think it grew to almost 15%. I think we were close to $120 million of total ancillary revenue by the time I left Bally. It created not only revenue enhancement, but it also created stickiness with the members. It allowed members to be able to get more than just fitness from us. It created more of a community. It allowed them to stay. They bought t-shirts with our branding and helped create more of a sense of community. So it was a great strategy all around, and it leveraged a fixed cost environment, which is how we operated because we were already paying rent and utilities, and so all that other amenities were very high margin.
And so where was the rub of financial performance at that time?
So we charted and watched revenue growth very carefully. We were a public company. We also watched earnings growth. Having not come from a financial background, but more from a management and operations background, the entire management team had basically come out of the financing side of the business. And so we watched, and numbers were reported, and we watched earnings seem to grow, and stock price for a while soared. We were on the NASDAQ, then we were on the New York Stock Exchange. Things seemed to be going in the right direction. The more we got into operations, the more we saw that there were some of the growth trends, if I recall correctly, were masked by opening new stores. And so there was a question of, what was actual same-store growth versus new store growth. and the acquisition growth. So there was a lot of moving pieces in there that were kind of moving at the same time, making the story just a little bit more complicated. But again, underlying all of this, soon became clear was the fact that the accounting was not right.
Just the crux of those accounting issues, was it revenue recognition? Is that primarily what it was around?
That's right. Revenue recognition, and then I believe also how costs were amortized and how fixed assets were amortized as well. But revenue recognition was the big chunk of it. If I remember, Bally at the time had been recognizing revenue. Bally, basically, if you go back, most fitness companies were selling month-to-month memberships. You paid every month, and I think if you were accounting for it correctly, the revenue was recognized as the money was paid. Bally sold 3-year contracts to members. And the way it worked was you actually paid 2 series of fees. You paid a joining fee, which was like $1,200, and you paid a monthly fee. And that $1,200 fee was amortized over 36 months. And then you had a small membership fee. And so the question was how quickly you amortized and recognized that membership fee that was being amortized. And there was all this talk that there had been a study and years, 20 or 30 year study that showed that the average life of those members, I believe, was something like 22 months. It turns out there really hadn't been a study, and it turns out that that was not the average life. We were recognizing revenue too quickly, which made profits and earnings look better than they were.
Yep, it accelerated, brought those forward, I
Correct.
guess.
It brought those forward beyond where they should have been.
I see. So Paul, late 2002, you're appointed CEO, and then I think April 2006. So it's really over like a 3-year time span, 3.5-year time span or so.
I think I left in August. It was almost
August,
4.
so-
Yeah, it was
okay.
probably December to August, so pretty close to 4.
And you're focused on one thing for several months, and then something else appears. And I know activism appears along this time continuum.
Well, I think you're right. We touched on the first 2 of the major challenges that we were addressing. One was operations, growing operations, cutting costs, making the company more profitable. The second was, of course, the financial fraud that was uncovered. And then the third became very quickly activism by hedge funds, which at the time were, I wouldn't say new, but it was a newer arena for activist shareholders at companies like Bally, which was not a General Motors type company. We really were dealing with fires in each arena almost from the start. The activists started pretty early, and I think very quickly, within a 3-year period, the entire shareholder base changed from mostly larger institutions to mostly smaller hedge funds who were looking to kind of play the stock and get short-term gains and really struggle and wrestle control without paying a shareholder premium. So it was really a very challenging environment.
How did it begin to materialize for you that there was this interest?
Well, you can see it in the SEC filings, the 13Ds, when people start to buy and file, and you can see who crosses the thresholds, and all of a sudden they're a filer, which means they're a big part of your company. What's interesting, or what I learned along the way, is you don't have to be a controlling shareholder in a large company to have a large voice, right? Any of these people who wind up buying even a % stake in your company, they do have a large voice, and they think they have a larger voice than they actually do.
With more insight, here's Chris Young, head of the Contested Situations Group at Credit Suisse.
Others take positions initially passively and then decide something happens with the company and they decide they need to get more active. Others are just active from the beginning, right? They determine that a particular company is ripe for shareholder activism. So they've got all of those different types of investments. So let's just say they invest in a company on an activist thesis or have invested in a company to decide that they need to escalate and become more involved and active. The playbook is constantly evolving. When I first started doing this, there were a lot of what I like to call drive-by shooting activists. The letter was sent publicly. It was very sort of poison pen style letter, attacking personally, ad hominem attacks against management. You still have a little of that. Guys like Carl Icahn like to tweet their position. I just bought 5%. I'll be talking to you in 5 minutes. But that's the exception to the rule. I think many, as the maturation of the asset class, you're seeing a playbook where the activists, at least initially, attempt to come in as sort of a kinder, gentler activist. We often see is a private letter written to management or the board, or maybe not even a letter, just a call coming in requesting, saying that we have a stake in your company, it's under regulatory disclosure limits, we would like to sit down with the CEO and talk about our thoughts. Mm-hmm. We think you're doing a great job, but, 1, 2, 3, 4. This is all outside of the public eye at this stage.
We'll be right back with our special episode on shareholder activism sponsored by Transparent Career. Hire the best MBA talent every time with Transparent Career. Learn more now at transparentcareer.com. Welcome back to our special episode on shareholder activism sponsored by Transparent Career. Chapter 2, The Letter. Here's more with governance expert Tanuja Dehne.
When an activist calls, I think the worst thing that a company can do is ignore the letter, the phone call. I think just basic politeness is to pick up the phone and find out with curiosity and inquiry what's going on, what can we do, and to start that dialogue. I think it's important to engage and find out what the issue is.
And now more with Paul Toback, former CEO of Bally Total Fitness.
And so it becomes a real challenge if you've got a majority set of shareholders who are much quieter and you have an activist minority. It's hard to figure out what the right balance is because you want to be responsive to all, and it's not necessarily true that a 1% shareholder speaks for everybody, especially when management winds up owning roughly the same or more. That's a delicate balance, I think. These hedge funds speak with a big microphone and they come in swinging. I think the first time we saw the filing and we saw the first shareholder group was a group called Partis. They crossed whatever the initial threshold was and they became one of our larger shareholders, a hedge fund based out of New York. And we went out to meet with them and, we gave them what I thought was a pretty comprehensive presentation, all public information, but we wanted to meet them, explain our strategy. Again, kind of very careful to share with them insights into the public strategy in a public way, but certainly answer any questions they had. At the conclusion of the meeting, which I thought had been very cordial and very affirmative, where heads were nodding and they seemed to really buy into the strategy and we were feeling pretty good about ourselves. Closed our presentation. They said, "This is great. We're really excited about your strategy. We would like a majority of your board." And so it just kind of like, what? Complete disconnect. You like us, you like the strategy, you believe in what we're doing, you bought into the company, and you want controlling interest. It was at that point where it automatically changes the tenor of the conversation and certainly of the relationship.
With more insight, here's independent board member Marjorie Bowen.
Most of the activists that I've worked with have not gone immediately to, this is what we want and we want a person on the board. Typically, there is this path of, hey, let's try to talk to management. Let's understand whether or not they're going to just support us. Of course, one of the big dilemmas is that the management team cannot provide a lot of information to an activist unless they're willing to lock up. And most activists are not willing to lock up. So there's a big disconnect with how much management can say. But I have not typically gotten involved until there's been some point along that path of communication, however one-sided it may be, where the activist is simply not seeing responsiveness, or in their mind, they're not seeing responsiveness. Ironically, it could be that the company is being extremely responsive, but they're not at liberty to say that because of disclosure rules.
Here's Paul Toback, former CEO of Bally Total Fitness.
First of all, we have fiduciary duties. You're not getting control of our board of directors just because you bought a 1 or 2 or 3% stake in the company. It doesn't work that way. You're lucky to get one director on a multi-person board. So it immediately set the tone for how they were going to approach us and for what we had to do in order to represent all shareholder interests.
Going into the room there, that happened at the tail end of this great meeting that you were having. What happened next? Did you just walk out of the room there with this hanging in the air?
No, I remember being very direct, saying that's just never going to happen. The thing I've learned is, and it became clear to me as time went on, you have to be as direct with them as they are with you. So I guess there's a lot of strategies for dealing with hedge funds and activist shareholders, and it depends on their approach and what their plans are. With the ones who were involved with us, they had no plan, and they had no strategy. So to me, it wasn't about debating ideas or approaches to creating shareholder value. They believed they could steal the company and bully management and the majority of the shareholders by being loud and activist and angry. And we believed our ideas were better, and we believed that we had a real plan and they had none. We believe that our fiduciary duty did not allow us to sell out the majority of our shareholders at the expense of a few people just because they said so. So I remember being very clear at the end of the meeting saying, well, that's never going to happen. And if that's your approach, then unfortunately, we don't see eye to eye.
With more insight, here's Tanuja Dehne.
Now, on the flip side, there's activism that can come in and be very, very disruptive. New board members, other board members having to leave the board, CEO terminations, very disruptive. When something like this happens, whether it's an activist comes around, whether it's a hostile takeover bid, bear hug, whatever it might be, it's a huge leadership opportunity for a CEO to cast some confidence and light and calm in the situation. So that's why when I say don't panic, it's a little bit tongue-in-cheek, but it's also quite serious. That the CEO, the executive management team, and the board needs to stay calm, focus, and act swiftly. There's things that have to happen. Planning, frankly, on a clear day on what might happen, and planning, and again, investor relations should be able to foreshadow something like this may be happening, and scenario plan is going to be critical. Now, in the background, a CEO and the board may need to bring in outside help, lawyers, consultants, to help in making sure that that conversation is, I don't want to say scripted, but some of the key points and messages are getting across. Behind the scenes and before the meeting ever actually happens, a lot of preparation with the CEO and the executive management team, CEO, CFO, with investor relations, and be fully prepared. And the best sometimes you can do is provide some assurances. And that's part of the script, saying we've received this, you would like us to do A, B, and C. I don't think it's unreasonable to ask to sit down with directors in that type of situation. If it's possible, I would like to have had an NDA in place. It's hard. I don't know if an activist investor would do that because it precludes the investor from taking some actions if they do sign a confidentiality agreement, but I would ask for it. And if not, then you do share the public information, and that's all you can share for FD purposes. But I wouldn't turn that away. I think that it's one of our duties is to engage, but our duties are also to be prepared. So I would ensure that I understood all of my legal duties, that it was well scripted, didn't go off script. I would want members of management with me, but if they only wanted the board there, I've seen that happen before, and I think that's okay, but the board has to be fully prepared, because the board's not spokespeople for the company. This is where you need the subject matter expertise. Typically, you would bring in a law firm that has done this on a regular basis to provide the guidance and the counsel to the management team and to the board to do this. Sometimes proxy solicitors, that might be later if there is a proxy fight, crisis communications firms. We have engaged with communications and investor relations firms in their arms specifically focused on preparing and planning for that event if it were to occur. And time is of the essence. We can't waste a lot of time circling the wagons. We have to have a plan of action in place.
Here's Chris Young, head of the Contested Situations Group at Credit Suisse.
We often get involved as a bank at that point, of course, and help the company prepare for that engagement. Again, the elephant in the room is ever-present threat of escalation. The activist, for their part, is trying to cultivate a brand that, hey, we're reasonable. If we can talk, maybe you guys can convince us we're wrong, and maybe, again, we won't escalate. And as you said, the decision tree at that point, we suddenly sell down, or we remain passive for months or sometimes even into a year or two period where we're quiet but we're engaging in a dialogue behind the scenes. That's very much like what the type of activism you'd see in Europe as well. It goes over better in Europe or in Asia. But again, the ever-present threat is the decision tree is no, we're not happy with how this is progressing. This dialogue is becoming frustrating to us. We continue to think we're right. In fact, we think we're more right than we were last week. Let's have some more meetings, site visits. And by the way, we'd like to actually meet with a couple of your independent directors too. That's become a fairly routine request from the brand name activists. And we want to meet your directors, not because we don't trust you, management, but because we want to give the same message to the board, and we want to make sure that there's no miscommunication, that when you're reporting back to the board as a manager, you're not leaving something out. That's at least how that request is justified by the activists. And we help prepare directors at that stage for that sort of meeting. They're becoming more used to engaging with shareholders, but again, engaging with this type of more aggressive shareholder, most directors probably need a little bit of training on the potential pitfalls of how that meeting could go.
We'll be right back with our special episode on shareholder activism sponsored by Transparent Career. Find and hire the best MBA talent every time. Leading Fortune 500 companies use Transparent Career to hire top MBAs across their organizations. Learn more now at transparentcareer.com. Welcome back to our special episode on shareholder activism sponsored by Transparent Career. Chapter 3. The Meetings. Let's join independent board member Marjorie Bowen.
my experience is that they'll start these conversations and activists will have their investment thesis, and they'll often show the board or the management team, this is our investment thesis. We want you to do A, B, and C operationally. We want you to do E, F, and G with the balance sheet. Or we don't think those are viable because you're already too levered, or there's not debt available to this industry, or it's not a good idea to pay out a dividend because you need money for investing. And operationally, we get it that it is what it is, but you're in a consolidating industry, so we want you to sell. Whatever their shtick is, right? They're going to have their wish list of priorities. At that point, the board and the management team can say to the activists, thank you very much. Or they can say, if you'd like us to respond to this, it requires you to lock up. 9 times out of 10 or 99 times out of 100, the activists said, no, we're not going to lock up. We want to be free to trade our stock every day. That's where it comes about, is when they actually get into that dialogue.
And now more with Chris Young, head of the Contested Situations Group at Credit Suisse.
And I would guess, Chris, they're restricted from sharing confidential information.
All of this is still under Reg FD.
Right.
The activist does not want any information that's going to conflict it and tie its hands with respect to trading. So it is a little bit of a dance, because a lot of times I'll get that question from directors. Why are we doing this? I can't tell them anything. You're telling me because they don't want to hear it, and they don't. They can see our recent investor deck. They can listen to our earnings call. A lot of it is just feeling each other out in some ways. To me, it's an opportunity for companies to understand how aggressive the activists may become. What are their true priorities out of their list of wants? What is their number one want? What's a nice to have? What's a need to have? The activist does it to assess reasonableness from the management's perspective, the strength of the board. They're trying to gauge whether they can drive a wedge between the board and management as well during this process.
With more insight, here's Paul Toback, former CEO of Bally Total Fitness.
In saying that they had their angle and it was just taking share, did you ever get into operational discussions, or did they come meet with management or come meet with any board members? Did you guys determine what they really wanted in this? Did it ever come clear? Did you talk about operations or...
Oh, no, they wanted control. In my view, they wanted to steal the company. They wanted to steal the company without paying a shareholder premium. They wanted to own it. They wanted to control it. To what end, I don't know. I guess they thought they could do a better job. But we went into multi-years of nasty proxy fights and public filings and back and forth name calling. Sometimes it got pretty personal. I come from a political background, and so my view of it was that we shouldn't leave charges unaddressed. It was very clear that those activists had the ability to say anything they want uncontrolled, while we operated in a very controlled environment. The company itself was hamstrung by lawyers and SEC regulations. When it spoke of anything important or anything significant, it had to speak publicly. It really created an uneven playing field, I believe, for how to actually fight a war with them. And then more significantly, the question is, what were we even fighting over? Yeah. And I think that's where we had the shareholder services on our side, is we presented our plan. And we said, let's see your ideas. If you've got better ideas than ours, we're happy to try and implement them. Or if you've got different ideas, then we're happy to debate them. But if you have no ideas, then you're basically a thief, and you're basically just trying to steal control for power's sake. We don't have much regard for you. That was at least our approach.
And now more with independent board member Marjorie Bowen.
And I will say these activists, they're smart people, right? I think that if any board were to ever discount how intelligent and how reasoned and how researched the activists are, that'd be a big mistake, because they spend a lot of time and energy, and they hire a lot of people to help them form a view that is extremely well-reasoned and educated on the industry, on a specific company. They're not just financial engineers. It's a big mistake to assume that an activist is simply a financial engineer looking for an M&A flip. However, a lot of them are looking for an M&A flip because they've concluded that that's the best way to monetize and gain value over the shortest period of time. As an independent director, once you get in and you get all of the information that, frankly, the shareholders don't have, very frequently you'll find, hey, an M&A flip right now is not the best path. Maybe it is, maybe it's not. Maybe you have to test it to figure out whether or not it is. And maybe that's a reason why you shouldn't announce you're in a process, because if it doesn't work out because you have something else going on that could be better, you don't want the world thinking you're for sale if you don't get a price you like. So I think it's quite complex, and I think that I don't have a preference, because as a director, I want to be as open-minded as possible about all of the opportunities available to the company. And having been both inside and outside, I know you do not have all of the information from the outside, even if you've paid all the consultants and done all the work that the activists have done.
We'll be right back with our special episode on shareholder activism sponsored by Transparent Career. Transparent Career is your solution for finding and hiring the best MBA talent. Leading Fortune 500 companies use Transparent Career to hire top MBAs across their organizations. Transparent Career's comprehensive search tools simplify the process of finding the ideal candidate for your role. Plus, you can easily set up interviews directly through the platform. Hire the best business talent every time with Transparent Career. Learn more now at transparentcareer.com. Welcome back to our special episode on shareholder activism sponsored by Transparent Career. Chapter 4, Making It Public. Here's Chris Young, head of the Contested Situations Group at Credit Suisse.
So then the decision tree is they get more frustrated. Let's say they can go over 5%, of course, file their interest becomes public in a 13D. They can convert derivative positions that haven't been reported right into voting positions. And now suddenly on their third quarterly 13F, it's reported, and everyone in my business tracks the 13Fs of well-known activists to see new positions that might be under 5%. They can even use the HSR as a way to disclose their position. Or frankly, there's nothing stopping them just putting out a press release saying that we own 0.8% of the stock and we don't like the company. So they're free to do that. At some point, again, that escalation will just takes the form of taking private conversations and now making them public. And now your share registry often turns over as people look at the target company as a potential event rather than trading on the fundamentals of the business. You may get a pop in the share price depending upon the market's assessment of the activist's plan, their track record. If you do get that pop, the company is a little bit on its back foot. Nobody wants to see a retracement of the share price back down to the pre-announcement. And so the dynamic changes, and now you have a public campaign. And now you have both the company and the activists have their brands at stake. Ideas can become a little entrenched at this point, right? Because now you're not having a private conversation, you're having a public conversation in front of every other shareholder, and you're also clearly being covered by the media. So the dynamic changes, but dialogue usually continues.
And now more with Paul Toback, former CEO of Bally Total Fitness.
It's interesting. They can say anything they want. They
Right.
have the loudest microphone. We didn't have Twitter back then, but
Right.
if they did, they would be tweeting things.
That's right. At the time, they were posting on our website. On Yahoo Finance, they were able to post on our message board. And so they were posting all day long, all kinds of stuff. And it's easy to say, ignore it, or it's easy to say, go about your business until you remember, we had close to 25,000 employees. I could ignore it, but 25,000 of my employees were reading it, same as now with Twitter, posting things on Facebook. And, so you had to have a strategy for how you communicated internally to make sure that the voice they were using wasn't the only voice being heard by your own employees. So it's the same kind of challenge you'd have right today. Microphone maybe is a little louder and a little broader in dissemination, but people knew very quickly inside where to read this stuff, and they were reading it. So employees were absolutely paying attention to what they were saying. And that created probably yet another challenge.
Chapter 5, The Compromise. And now more with Chris Young, head of the Contested Situations Group at Credit Suisse.
During this entire process, right, at any moment, the share price goes up for whatever reason. The company conducts what we would call self-help. And you often see this. Company, will announce its own buyback, will add new directors of its own choosing, announce a strategic review of a certain business line. And the share price may go up, and that may be enough for the activists, as you mentioned before, just to say, we made our money, and now they de-escalate. They may keep the stock, but, let the advance notice deadline for nominations to the board pass and not escalate to that. They may sell down and say, we made our money, and reallocate their capital somewhere else. They have the opportunity to exit anytime they want. They have the opportunity to escalate anytime they want. Now, one of the advantages that the activist has in this dance is they control the timing in many ways, and the company needs to sort of react or anticipate what's going to happen. And then the company can either dig in and do nothing, as I mentioned, or the company can take these self-help steps that may or may not assuage the activists. Ultimately, we may reach a settlement at any time in this entire escalation path. Back when the conversations were private, you can enter into a settlement agreement. When they become public, after it's been escalated, And even after a proxy fight's been launched, you see settlements being reached sometimes a day or two before the annual meeting. All along that time is an opportunity for each side to come to some sort of agreement, which of course takes an infinite number of forms.
Here's Paul Toback, former CEO of Bally Total Fitness.
Somebody smart once said to me, they go from being owners to renters, these short-term looks of people who want to just get in and out of the stock and day trade it or move it up and down and get in and out. I remember one of these activists had been in and were calling all the time, and they were always trying to give their advice, and they were active at the meetings, and then literally one day I got a phone call, I sold all my shares, I'm out. Well, that's it, never heard from them again. I mean, that was it. They had said their piece and tried to manipulate and hassle, and then they were gone. No long-term stake in the company, no view of what things should happen long-term, no real strategic interest.
They got the price they were looking
They got the price
for.
and they got out. They made their money and they left. So that is, I think, a continuing concern in terms of public companies, in terms of your move for short-term gains versus long-term profitability and sustainability and who's right. And you see that activist bent and question plays out all the time. Big companies, small companies. I mean, should you be, I think companies like Apple, with all that retained cash, should they be dividending out? Should they be retaining it? Should they be using it for growth? I think those issues don't go away.
Here's independent board member Marjorie Bowen.
I think activists also have very unrealistic expectations about their willingness to lock up and be part of a long-term solution. And that's something that is just part of the dilemma. There's not an equilibrium of communication. It's very one-sided. Definitionally, the activist talks, the board listens, can't say anything back. Management listens, can't say anything back. And activists aren't willing. They say they're long-term investors, but the fact of the matter is that if they were long-term investors, they'd lock up. Mm-hmm. But they're not. They're not willing to. And so it is a two-way street here in terms of fixing the problem.
Paul Toback, former CEO of Bally Total Fitness.
And I think in the end, when they won, I think they added 3 people to the board. What actually happened was we agreed to compromise in what I thought was an interesting strategy by us. They ran a slate of, I believe it was 3 directors, one of whom we opposed adamantly. And so we agreed to run a slate of 2 of the same directors to propose the same 2. And our one slate just had that one director differently, with the hopes that that would let people see that we were really trying to be reasonable. We would take the 2 that we believed would be the most reasonable and oppose the one who we thought was really a plant to do nothing but create havoc on the board and be like the lead person to try and seize control of the board. But in the end, all 3 of their directors did win. And while we retained a majority of the board, it basically brought the divisiveness into your living room as opposed to having it outside on the street. Again, they came with no good ideas and no experience, no fitness company experience, no real insight.
They were just allies of the activists.
Correct. So yeah, it becomes another challenge. I mean, it really, I guess if you look at it, is another lane to manage, which is managing your board, which is not only concerned about doing the right thing, but also is worried when you've got activist shareholders about their own personal liability and ultra careful to make sure they're not only doing the right thing for the company's operations, but that they're doing the right thing from a governance standpoint. And so that's another thing to manage. If you've got a 9-person board and you're the chairman, it means you could be fielding phone calls from 8 other people all week long, every week, while you're trying to manage your business, and in our case, dealing with your accountants and dealing with the hedge funds. That's a lot of different pathways.
Chapter 6, The Proxy Contest. Chris Young, head of the Contested Situations Group at Credit Suisse.
And of course, the next escalation step would be if the activist gets frustrated. Now we've gone public, yet they're still not getting what they want, and they still don't think that the company is listening to them. Their next and final step is to, after already going public, is to run a proxy contest to actually force their way on the board through a shareholder vote to try to create change from the inside. Again, going back to the point I made before about the operational activism, the quality of the nominees, the board nominees that the activists are able to recruit has improved over the past decade plus. Yeah. Often the principal of the hedge fund wants to be on the board too, to have the shareholder watchdog in the boardroom, but increasingly many of them are happy just to have influence on maybe 2 seats and say, these are 2 gentlemen or women that we would like to have on the board. I don't need to go on the board as Mr. Activist. I'm comfortable that if you agree to do this buyback and do one other thing and then put these 2 individuals who are independent of me, on paper at least, then we're happy. That would be a version of the governance change. Again, it doesn't have to be a principle from the fund itself to go on the board.
independent board member Marjorie Bowen.
Very early on in my directorship career, I was approached by InBev when they were trying to take over Anheuser-Busch. They were thinking about as a mechanism to get Anheuser-Busch to sell. And if you recall, some of the Busch family wanted to sell, but the rest of the board didn't. And so there was this disconnect. And the Busch family did not own a particularly high amount of Anheuser-Busch, but they were obviously important shareholders, and they wanted the company to be sold. And so they were working with InBev to come up with a slate to put it to the shareholders, basically, and say, hey, your board isn't looking at M&A. We want to look at M&A. We're the buyer. Vote for us. And so I was part of that InBev slate of directors with the idea that, hey, you're a corporate governance person, you're a financial transactions person, and if the shareholders want a process, we need somebody like you on the board for a process. So that was kind of my first slate experience. Literally, as soon as the slate was announced, the Anheuser-Busch board took that as a signal to say, okay, it's time that we actually listen to what some of our shareholders at least are saying. Let's negotiate. Let's see what kind of price we can get, and then let the shareholders vote on whether or not they want that price. InBev ended up buying Anheuser-Busch, and that was that. That was kind of my first slate.
And then when did the interest from activists come for you to serve as one of their nominees?
Well, so interestingly, one of my colleagues had referred Shamrock, which is an activist firm in Los Angeles. They had done the Save Disney campaign. One of my former colleagues had referred them to me as somebody who knew a lot about corporate governance and who was now doing board work. And they were in the process of putting together a slate for a company called Texas Industries. Texas Industries at the time was one of the larger independent cement companies in the U.S. They had 2 or 3 years of shareholders withholding the vote in excess of 30, 40, very high percentages of withholdings. But, one of the weird things about corporate governance, it's not as if it's real easy to say, hey, I'm going to vote for A instead of B, right? There's not a competitive running process typically. It's just, here's the slate, you vote for them, or you hold your nose, or you don't. And this particular company, the shareholders were not happy. And Shamrock finally decided that they were going to run a slate. And so I joined that slate. It was really a fascinating process because we did the whole kit and caboodle of educating the shareholder base about what the platform was going to be about. The board that was staggered, so there were 3 of us on the slate. It would have taken a few years for that board to turn over. We had an agenda that we wanted to put in place. We went to ISS, we went to Glass Lewis, etc. So it was a full-blown proxy contest for my first interaction with an activist. So it was very interesting.
We'll be right back with our special episode on shareholder activism sponsored by Transparent Career. Transparent Career's comprehensive search tools simplify the process of finding the ideal candidate for your role. Plus, you can easily set up interviews directly through the platform. Hire the best business talent every time with Transparent Career. Learn more now at transparentcareer.com. Welcome back to our special episode on shareholder activism, brought to you by Transparent Career. Chapter 7, After the Proxy. And now more with independent board member Marjorie Bowen. After a proxy contest, when you're finally the shareholder nominee and now the independent director on the board, what's welcome week like?
I'm an independent director and I work for everybody. I might get put in place by a particular shareholder, but once I'm there, I work for everybody. And so I need to really try to keep in mind that some of these activists try to shortcut as well. They might try to just say, hey, here's a company, let's get somebody on the board. Well, they need to try to go through a process where it's productive and working with the board first. Ultimately, what you want in the boardroom is you want people to be respectful and function and generate consensus in a positive way and have it be professional and productive for the company. I've had both sides of a large spectrum. I mean, I literally have gotten there and not been wanted, had it been the result of a shareholder vote that the board has then lost. And so 3 of their beloved colleagues are now gone and now they're stuck with you and you're not liked. And you don't set the agenda. You're not on any committees. You are shut out as much as possible. That's not productive. And that is a long, slow haul. And that's one where over time, the activist has to have a lot of patience, because even though you have someone on the board, it might take 2 or 3 cycles before you have enough people to make it productive. So I was elected in a contest where it was a staggered board and it was a proxy contest, and the activists knew that this was going to be the first of 3 because they knew that they weren't wanted. They knew that it was going to take time. And so there was some expectation and some negotiation that, hey, there'd be certain governance changes made early on. But to get what the activists really wanted, they were prepared that it might be one of 3 proxy seasons to get through and actually control the board, or at least 2, because if, say, it's a 9-person board, you got to get through 2 seasons, right? Do 3. On the other hand, I've been welcomed on as a result, not of a proxy contest, but as a negotiated settlement where people were extremely gracious, very welcoming, had an orientation, gave me every opportunity in the world to come up to speed. In fact, that board was pretty much already doing what the activists wanted them to do. But again, back to the disclosure, they couldn't say that. I came along to the party, and in that case, the activists required that there be an announcement of the company pursuing strategic alternatives and me joining the board at the same time. I think with hindsight, I would have advised against making the announcement of strategic alternatives. Again, if it doesn't work out as well as you'd like, why do you want to announce that if you don't know for sure that you're going to be able to have something that's really great for all the shareholders? It was a little complex situation, but certainly the board there was quite welcoming. There was no friction whatsoever. At the end of the day, I'll say that same board, the board that hires the CEO and the board that is responsible for the strategy in place that hasn't worked out as well as the activists would like is always a little bit slower to move than somebody coming new with fresh eyes. And I think that that's just human nature. I don't think that that's anything, but when you're responsible for something, you want to give it every try you can. It's much easier for somebody new to come in and say, this isn't working. When I joined the board, not as an activist, but we had an activist start rattling the cage of an apparel company years ago, public company. I joined mid-year. Christmas is the big season. Christmas didn't go so well. I was still kind of finding the bathroom at that point and, didn't really rattle the cage too much, but it had been the second Christmas in a row that things weren't going well. So about 8 months into my tenure, I was saying, hey, time for a change. And right about that time, we had an activist start knocking on our door. And I said, look, this guy, all he wants is us to be considering things to make the company better. We should be considering those things. Well, the rest of the board had hired this CEO. They weren't ready to scrap that CEO. They weren't ready to throw the towel in. Instead, we took 10 months allowing the CEO to tinker and throw someone else under the bus. And, by then it was too late. I've found time and time again, the boards that have made decisions that haven't gone well, and therefore you have an activist because you have underperformance, they're just too slow. There's just not the sense of urgency that the activist community would like to see.
Got it. So in coming in there, in terms of providing that urgency or that impetus towards urgency, where people are feeling remorse that they just lost 3 of their great board colleagues and you're going in representing really the activists, what's your posture and how do you start finding productivity with the board? What's your approach?
My approach is to try to say I'd like to be part of a consensus decision-making process that recognizing that a collegial board is far more productive than a non-collegial board. That being said, I'm here for a reason. And so let's make sure that every board agenda has those reasons talked about at length. Let's make sure that the board is not bogged down with just reviewing results, but actually figuring out what we're going to do about the results, because that's why I'm here.
Chapter 8, The Advice. With more insight, here's independent board member Marjorie Bowen.
So there's a lot of groundwork, not in the meetings per se, but prior to that, making sure that public company board work is tedious in a lot of ways. There's the comp committee. Well, is the comp committee really addressing what the activist wants? Is the audit committee focused on making sure that if there's any issues from a balance sheet perspective that should be looked at, that they can be looked at? Is the nominating corporate governance committee really considering, hey, if an activist has wanted one thing, are the directors the right directors for the next cycle through? And then most importantly for that board meeting, What is the agenda? And are we going to have the right agenda to get where the activist wants to be? Amazingly, there are many, many boards that still just meet quarterly and don't get together even by phone in between meetings. And I think this is a big issue. Activists are watching their companies every day. The boards need to be more active as well. They need to be getting monthly reports. They need to be having monthly calls to understand not just what were the results, but what are we doing in terms of the operational issues, the financial issues that the activists are talking about. Typically, if there was a process announced, then it's a whole nother ball of wax because a strategic committee has been formed, and that is almost a weekly commitment, if not more than a weekly commitment once you get going. But if it's, hey, here's an activist and 3 new guys show up because we won a proxy contest, it's trying to get the governance changes in place so that the shareholders are heard better, but it's also just trying to make sure that the rest of the board gradually can adopt this concept of you need to stop talking about just results and start figuring out how to implement changes. It's bringing a sense of urgency to everyone, hopefully. And I don't know how to say it better because that's I guess when I really think through my biggest takeaway, it's that when an activist brings somebody like me on board, the sense of urgency gets heightened. That's 90% of my job is just heighten the sense of urgency, heighten the sense of awareness on what shareholders want, as opposed to getting bogged down in let's review the results.
And so what you're describing, it sounds like great execution and planning around what good corporate governance should look like. You looked at each committee, what's on the agenda, and then the details underneath on what gets debated and brought out on that agenda. So it's not like an activist-driven thing. It's just a good corporate responsibility.
That's right. I'll give you just a tangible example that really helps, I think, listeners understand. So when I joined a board recently, the audit committee meetings were about 3 to 4 hours long, which, by the way, is a pretty long audit committee meeting. And they covered financial results ad nauseum, including a lot of results that I thought were operational and, frankly, not the purview of the audit committee. And then you go to the next day and there'd be the board meeting. And the board meeting was a day and a half. And it would cover 100% of everything that was covered in the audit committee, which, oh, by the way, is a colossal waste of valuable time when you're together to cover the same thing twice. And so one of the first things I started working on there was, why are we covering the same information twice? Let's make sure the audit committee is meeting for the things that the audit committee is truly responsible for. And let's make sure that the board meetings are covering what the board is truly responsible for. And let's use the time we're going to pick up in one place or another on strategy, not on reviewing results. And it sounds so easy, but when you're talking about a team, a group of people that comes together 4, 5, 6 times a year for a day and a half, and that's your governance, if you can pick up 2 hours and shift it from reviewing of financial results to talking about strategy, that's a huge shift. But, it's not so easy to go in and, as the newcomer and say, by the way, I want to change your agenda.
Right. Yeah.
So it's easy for me to say it, and that's a true story. But it took about a year for me to get everyone to understand this is not a good use of time. Why are you doing this way? Well, it's because that's how we do it here. And you don't want to be the new kid coming in and saying, well, the way you do it is wrong.
Yeah.
But it's, hey, here's why maybe it makes sense to do it a different way. And then get people to understand that and leave their old ways when in fact they were the ones who came up with it, or they were the ones who preferred it that way, or they've been going along for a long period of time.
You say, it sounds simple, but it isn't. It got that way. And your first question was, why are we doing this? And it's almost sounds like a rhetorical question, but I'm going to ask it specifically. Why does that happen? I have to assume their intentions are good and they intend something well from it, but then it just evolves or devolves into, here's what we have, and you come in and bring a fresh perspective and you're asking why. But why does that happen? In
a circumstance like that, and I saw it as an advisor over many, many years, and then I saw it as an internal board member. I think what happens is, the CEO works for the board. So the CEO's biggest fear is pissing off a board member. So if a board member happens to have a particular interest in something, the easiest thing for the CEO to do is throw it on the agenda, whether or not it makes sense to put it on the agenda. And unless you have a bulldozer type chairman who's going to actually really kind of keep tight controls, the chairman wants to be deferential to their colleagues. So all of a sudden you have 9 people or 7 people or however many people, each one with their particular thing of, hey, I want to see this at a board meeting. Hey, I want to see this at a board meeting. And it gets out of control pretty fast. Mm-hmm. And everyone has their own ideas as to why it's important to review this particular series of financial performance measures each and every time, or why it needs to be at the audit committee and then again at the whole board meeting. So it gets out of control because the CEO wants to make everyone happy. And people, frankly, forget that the board is supposed to be spending the vast majority of their time on strategy. I am a firm believer of, if you want to review financial results, do it over the phone. Don't use your time face-to-face to be reviewing what's happened. And also, come to the board meeting prepared. CEOs forget that board members hopefully do review materials ahead of time. They're familiar with what's in there. Don't throw 150 pages at them. Throw the information at them that they need, and they'll come prepared. But I think that just the dynamic of how it is, they don't meet enough. And so they end up spending their time going through stuff that, frankly, is out of habit and not streamlined because a chairman and a CEO are deferential and don't keep their eye on the prize of it's the strategy. Management should be, if they demonstrate they're a shareholder of a significant size, you should always be willing to listen to your shareholders.
Chris Young, head of the Contested Situations Group at Credit Suisse.
What drives the timing when you say the activists sort of drive the timing? Is there a response time?
They drive the timing based upon, they decide when to go public. With rare exception, a company does not want it to go public because they know that it will change their share registry and their employees are going to be distracted, right? So, but the activists can just decide when it wants to go public. What controls the final escalation typically is that nominations deadline. We all talk about circling that date on the calendar. The activist has it circled, the company has it circled, and they know typically after that date passes, the company's leverage increases for another year, meaning typically, unless there's a way to act outside that calendar, which is one of our jobs, along with outside counsel, is to examine the charter and bylaws. Is there a right for shareholders to call a special meeting? At what threshold is there a right to act by written consent? At what threshold can they remove directors? Because activists have been willing to use those tools and tactics to act outside the annual meeting calendar.
Surprise attack.
A surprise attack, or just not being bound to that nomination deadline. So it's not that single date circled on the calendar. Yeah. They can act 365 days a year.
So with that single date, there's a hunting season. There's a
hunting season. And the pressure, it builds up to that date. I think
when
for both
is that
sides.
Date usually? Chris,
the date is
February timeframe?
For many of the companies that have spring annual meetings, it's February, March. I mean, you see versions. It's usually a window of 30 days long that opens and closes, of about a month-long period, maybe 90 days before the annual meeting, 120 is a typical one. But you could see 60 to 90. You could see I'd say 90 to 120 seems to be the most common.
And then if you back up from that date, then when is sort of that prime period for buy-in of the stock?
Yeah, so if you circle that date and say it is, and a lot of them are in February, then with that playbook I just described, I tell a lot of companies with this new, kinder, gentler playbook where at least the initial approach is private, you can just back up 3, 4, or 5 months before that. Obviously, every situation is different. Sometimes we have a couple of clients right now that have been approached. They're after their window. We're in the private mode. There's nothing that the activists can do really until next year's annual meeting. So I was just talking to a colleague about it. I didn't know if this is a new trend where the runway is even longer. But I'd say over the last few years, it's been sort of that 3, 4, 5 months sort of runway where the activist feels that gives me enough time to have the initial meeting, a follow-up meeting, a meeting with some of the directors, think about it a little bit more, try to become public about it, and then once they become public about it, gauge the support from other shareholders, which is the ultimate factor, right? And then decide, now we're getting close to that date circled on the calendar. I've got to decide whether I'm going to move or not.
Interesting. So maybe around Halloween and all the way through the rest of the holidays.
Yeah, definitely. The fall, I'd say, even sort of after
Labor Day.
After Labor Day, and after all the activists come back from the Hamptons, you'll see more of that activity in the fall for those spring meetings.
With more insight, here's Paul Toback, former CEO of Bally Total Fitness.
Looking back with 2020 hindsight, is there anything in that massive array of moving parts that you were dealing with, is there anything that you could have waved your magic wand and changed, and on the other end of it helped with Bally's success?
You know, I don't think about it much anymore, but I know in the year or two after I left, I think about it, and it sounds a little self-serving to say, but there isn't anything. I mean, I think we were faced with so many hurdles, and I think at the time, with the information presented to us, we did everything we could think of, and even looking back, I can't think of anything. You know, I still would have been as aggressive with the hedge funds. I still would have been as honest and aggressive in fixing the accounting systems and complying with the SEC and getting our financial statements refiled, and I would have been as relentless as I think we were in trying to improve the operations at the same time we were doing it all. So again, it sounds weird to think like I haven't taken any lessons from it, but I don't know. There wasn't anything massively different we could have done. I mean, maybe I could have been a little calmer, you know, with 10 more years of experience and a lot more gray hair. Maybe I would have been a little bit more understanding of all the challenges than I was at the time. But in terms of actions we took, I go back to that first meeting, right, to kind of put a fine point on it. I would not have given control of the company to them in the first meeting and said, okay, it's yours, go do what you want with it. Nor would I have allowed the hedge funds to really come in and take control of a company without paying shareholders a control premium, especially when they had no ideas for how to run it.
Let me ask you this, and maybe it's a question coming from an optimist to be maybe a little bit pessimistic, but theoretically, when we talk about corporate life cycles, is there an end? Is there an end for a corporation? And with what you saw happen to Bally, to go where it did, from where it did, and then down, is there a corporate life cycle that, try as you might, you can't do anything about, generally speaking?
Well, I think with Bally there was. I mean, I call it the death spiral. It's like you're paddling as fast as you can just to keep your nose above the water, and at some point, that's unsustainable. You needed capital to keep the facilities new, but no one was going to give you capital because you were over-leveraged, and without the capital, you were ripe for competition to pick you off. I think there probably is a corporate lifespan for every company. I think Bally could have, like a sick patient, extended it with the right medicine and administered at the right time. Mm-hmm. I think we missed that opportunity. Frankly, I would say by the time I became CEO, it was too late. The company had already had the debt structure it already had the deferred maintenance it had. It didn't even have the money to double the advertising if you wanted to really make a run at it. What we did, I think, was a Herculean task in growing revenues, I think 22%, even though we really weren't spending any more money to do it. So with all those challenges, I think the writing was on the wall. I think had actions been taken that were smarter and more strategic earlier, probably 5 to 10 years earlier, I think that the life cycle could have been extended. I think had Bally moved quicker to take over that low-cost space and had the money to put back into the clubs, look, in our space, Planet Fitness has occupied the space Bally used to occupy. The low-cost $10 a month. I just saw an ad this morning for Planet Fitness. $5 down, $10 a month. Bally had been the $19 provider for almost 40 years, occupying that low-cost, really amazingly affordable space where other clubs had been $30, $40 a month. Bally could have been the $10 club as it saw the market move. It was too late. I have a picture I keep on my wall. It's a picture of a guy sitting alone in the airport with just his bag, and all the chairs are empty as he's waiting for his flight. And the guy, whose name again I forget, was the guy who filled in for Ringo Starr when Ringo got sick one time in the 60s. So I look at that, and for 1 or 2 weeks, that guy was in the Beatles. He was the fourth Beatle. He played every gig. He was in the most popular band in the history of music. And when Ringo came back, he was sitting alone on a chair, waiting for his flight with nobody around him, and that was it. The point is, that was his moment, and your moment's fleeting, and like you say, everything has a life cycle. So I think the important lesson to take away from that is you need to move as fast as you can when your moment is there, because you don't know what your life cycle is going to be from a business standpoint. You don't know what your life cycle is going to be from an individual standpoint. And I think that's a good lesson for anybody in corporate life. Everything ends or changes. Everything goes through a life cycle and a relevancy period, and so you don't want to miss your moment. That guy had his moment, and then it was over very quickly.
That concludes this special episode on shareholder activism. Warm thanks to our guests, Paul Toback, Tanuja Dehne, Marjorie, Bowen, and Chris Young. And special thank you to our sponsor, Transparent Career. For those footnote readers, as always, please see the back of our album cover. For those interested, the rise and fall of Bally Total Fitness are covered in 2 cases at Harvard Business School by strategy professor John R. Wells. Please follow our links to the cases on the HBS website. All previous episodes are available on iTunes and our website, leadershiplyceum.com. Please tune in to our next episode on philanthropy. We'll cover the subject from many different angles, from the perspective of the giver with University of Chicago benefactor Bernard Del Giorno. Bernie also advises clients on the subject of philanthropy and their own giving in his role in private wealth management at UBS. We'll cover the angle of the recipient. We'll glean the perspectives of Jennifer Sampson, CEO of the United Way of Metropolitan Dallas. Jennifer led a turnaround in Dallas and has led the development of programs that fund impactful, novel social entrepreneurship. We'll also introduce you to a group of public company CEOs in Ohio that are leveraging their musical talents to raise money for charities in Ohio. 2 of these CEOs are board members of the Rock and Roll Hall of Fame. Please keep a lookout for that next episode in early December. Hire the best MBA talent every time with Transparent Career. Learn more now at transparentcareer.com. This podcast, Leadership Lyceum, a CEO's Virtual Mentor, has been a production of the Leadership Lyceum, LLC. The only purpose of the podcast is to educate, inform, and entertain. The information shared is based on the collection of experiences of each of the guests interviewed and should not be considered or substituted for professional advice. Guests who speak in this podcast express their own opinions, experience, and conclusions, and neither the Leadership Lyceum LLC nor any company providing financial support endorses or opposes any particular content, recommendation, or methodology discussed in this podcast. This has been a production of the Leadership Lyceum LLC, copyright 2017, all rights reserved.